Okay, let's unpack this. If you're looking for the absolute latest, most vital intelligence on Bitcoin, well, you've landed in the right place. Today, September 18th, 2025, has delivered a set of truly significant developments that could really define Bitcoin's trajectory for months, maybe even years to come. So our mission today is to cut through all the noise, distill the most important nuggets from the day's market intelligence briefing. And this isn't just about what happened, but really what it means for you. We're talking about two pivotal events today: the Federal Reserve's recent interest rate cut and the SEC's landmark regulatory approvals.
Yeah, and it's crucial to see these not as, isolated headlines. They're really two powerful long-term bullish catalysts intertwining, reinforcing each other. What's particularly interesting, I think, is how the market has absorbed them. There's a maturity there we haven't always seen. It suggests maybe a fundamental strengthening of Bitcoin's investment thesis, something beyond just the short-term speculation.
Right. So first up, let's zoom out a bit to the macro picture. The U.S. Federal Reserve just made a pretty substantial move. Now, it was anticipated, sure, but the implications are, well, far richer than just a simple rate cut. The Fed announced its first interest rate cut of 2025, just a 25 basis point reduction. That lowers the federal funds rate target to between 4.00% and 4.25%.
And that's the first cut since December 2024.
Exactly. So it really marks a formal shift, a distinct shift to an easing cycle. The decision itself had overwhelming support too. 11 of 12 committee members voted for it. But here's where it gets really interesting, I think. Chair Powell framed this. Well, he didn't frame it as a sign of economic triumph. He specifically used a risk management narrative.
Risk management.
Yeah, and he explicitly prioritized the weakening labor market. He noted average job gains are only about 29,000 per month recently, prioritizing that over what he calls somewhat elevated inflation. That's a clearly dovish pivot. It signals they're more worried about a slowdown than inflation right now.
Very clear signal.
And then there's the famous dot plot showing where members see rates going. It revealed expectations for 2 additional 25 basis point rate cuts before year end. That implies 75 basis points of easing total for 2025. That's potentially a lot of liquidity coming.
And connecting this to the bigger picture for Bitcoin.
Yeah.
The Fed's actions create this powerful dual tailwind. It's really hard to overstate. On one hand, you have the immediate impact of the direct liquidity injection. Lower rates mean capital flows out of lower yielding stuff like bonds and into higher return growth assets. Bitcoin, in that environment, naturally becomes a more attractive place for capital looking for yield and growth.
Makes sense.
But there's an even more profound implication, I think. Chair Powell's public admission of this policy dilemma, trying to support a weak labor market while inflation is still, somewhat elevated, is subtly but powerfully erodes confidence. Confidence in the dollar's long-term purchasing power.
The stagflationary scenario.
Exactly. This stagflationary scenario isn't just a tough spot for the Fed. It's practically Bitcoin's original design brief coming to life. It's like the ultimate stress test for fiat currencies. And Bitcoin is, well, by design, positioned to excel as that scarce, non-sovereign store of value precisely because it offers an escape from that kind of policy dilemma.
Okay, so while the Fed was busy recalibrating the economic engine, another tectonic plate was shifting right under the financial landscape, adding crucial regulatory certainty to this whole narrative. The SEC just announced something that's, well, it's generating a lot of discussion, signaling a real paradigm shift for crypto investment products.
Yes, this is big.
The Securities and Exchange Commission officially approved generic listing standards for commodity-based trust shares. This applies to major exchanges like Cboe, BZX, NASDAQ, and NYSE Arca, and it explicitly includes spot digital assets. This is huge because it's a clear move away from those subjective, agonizingly slow case-by-case approvals we've dealt with.
Where the old way was painful.
Totally. And what's even more impactful, perhaps, is the new fast-track rule. Eligible spot crypto ETPs, that's exchange-traded products, can now launch in just 75 days. That dramatically lowers regulatory barriers, speeds up innovation significantly.
75 days, that's a game changer.
It really is. And, as if to underline the immediate impact, the SEC concurrently approved the Grayscale Digital Large Cap Fund. That holds a basket of spot digital assets. So it's the first concrete example of this new streamlined framework in action.
So the natural question then is, why is this potentially more significant than even the spot Bitcoin ETF approvals back in 2024? I mean, those were absolutely monumental, no doubt.
But each was a bespoke decision, right? A one-off.
Right. Each one felt like a separate battle. Exactly. These new generic standards mean the SEC is shifting. It's moving from being a discretionary gatekeeper making individual calls to acting more like a market regulator, providing a predictable, scalable framework for a whole asset class. And that kind of regulatory certainty, that is precisely what large, traditional financial institutions need, what they've been waiting for. It lets them build out long-term product roadmaps.
Ah, so it opens the door for more than just Bitcoin products.
Precisely. It promises a wave of innovation, think thematic funds, diversified asset baskets, driving substantial diversified capital into the entire crypto ecosystem, not just isolated products. This isn't just about Bitcoin anymore. It's really about the whole digital asset space maturing within traditional finance.
Okay, so two massive developments then. A dovish Fed, a green light from the SEC. How did Bitcoin itself react? Because it wasn't with that manic volatility we might have expected, say, in earlier cycles. It was surprisingly calm, which really speaks to its growing maturity, maybe that institutional depth you mentioned.
Yeah, the price action was telling.
Over the past 24 hours, we saw an initial, very brief dip, just below $115,000 right after the announcements. But that dip was met quickly with significant buying pressure. Then it was followed by a steady, pretty low volatility climb into the $117,000, $118,000 range. As of our latest data, Bitcoin's trading around $117,756. That's a post-announcement gain of about 1%.
Only 1% after all that news.
Right. It certainly isn't your typical sell the news event. It strongly suggests the market was processing those deeper signals, the dovish Fed outlook, not just the rate cut itself. And it's definitely not overlooking the SEC's foundational shift either. It feels like the market absorbed it, took a breath, and then just continued its measured climb.
And if we delve deeper into that, the underlying technical strength supporting this move is, well, quite compelling. It confirms that bulls are clearly in control right now. Looking at the technicals, solid short-term support seems established now, firmly between $115,700 and $115,900. There's a critical pickup point around $114,000 that really needs to hold if we see any significant pullback.
Okay, $114,000 is the key level to watch downside.
Pretty much. Immediate resistance is right around $118,000, with that formidable psychological barrier at $120,000 as the next major target. Lots of eyes on that number. Momentum indicators like the RSI, the Relative Strength Index, they look healthy, around 59. Think of it like a car engine. It's running strong, but it's not redlining.
Not overheated yet.
Exactly. I guess there's still plenty of room to run without being in that dangerous overbought territory. And from a historical context, this 2025 bull market, it's striking how low the volatility has been, relatively speaking. Max drawdowns have been a modest 30%. Compare that to like 80% drawdowns in past cycles. I remember back in the 2017 run, a 30% drawdown felt like, well, a calm Tuesday.
Yeah, perspective matters.
Right. This 2025 market with its modest 30% dips, it feels fundamentally different. It really suggests that institutional capital is dampening that wild speculative fervor, providing a much more stable floor, makes these moves feel more durable.
Okay, now here's where it gets really interesting, I think. For people looking for signals on conviction and maybe volatility potential, the derivatives market. We're seeing consistently high open interest, right? Over $40 billion currently. But crucially, relatively low 24-hour liquidations. Only about $32 million in shorts got liquidated.
Only $32 million. That's low for this level of OI.
Exactly. That combination indicates a non-speculative, measured reaction to the news, not some frantic scramble. And crucially, the long-short ratio is sitting near 50-50. Pretty balanced. Plus, funding rates are muted, maybe neutral, across major exchanges, which suggests healthy two-sided conviction and, importantly, no dangerous skew in leverage that could trigger a cascade.
Right. So the obvious next question is, what happens if Bitcoin does decisively break resistance, particularly that $120,000 level? Because we see this massive concentration of short-side liquidity just sitting there, over $2.4 billion in short positions, all poised for liquidation if Bitcoin moves decisively above that $120,000 zone.
$2.4 billion.
Wow. Yeah. This short squeeze potential could rapidly accelerate upward momentum, especially if it's fueled by continued spot market buying, maybe from those new ETPs coming online, for example. It's a setup that suggests a fundamentally driven and therefore likely more durable upward move.
Wow.
Because it would need genuine buying pressure to trigger it, not just, speculative leverage playing games.
That's a significant amount of capital just waiting on the sidelines there. But is there a scenario where this doesn't happen, or maybe where that short side liquidity gets absorbed without a massive spike?
Well, it's a valid question, and certainly possible in let's say, a very mature market structure. Anything's possible. However, given the confluence here, these two really powerful catalysts happening almost simultaneously. The Fed's dovish turn, the SEC's broad regulatory clarity. The conditions feel pretty right for those shorts to get squeezed. While institutional capital does tend to dampen extreme volatility, yes, a break of such a significant psychological level like $120K, especially combined with the specific concentration of short interest, it often triggers a kind of reflexive upward move. You'd need some serious sustained selling pressure right at that level, or maybe some unforeseen negative news, to absorb that $2.4 billion without a significant push higher. Right now, the path of least resistance, fueled by these fundamentals, it really looks upward for Bitcoin.
Okay, interesting dynamic there. Now, the institutional flywheel you mentioned, it really seems to be accelerating, bringing some fascinating new products to market. Products designed specifically to address those previous barriers to entry for big funds. Case in point, Valor's One Valor Bitcoin Physical Staking ETP, exchange-traded product. It just launched on the London Stock Exchange.
Yeah, this one's clever.
It seems like a game changer because it's the world's first physically backed Bitcoin ETP that also offers an additional yield, about 1.4% annual staking yield. And that yield is accrued and reflected in its daily NAV, its net asset value. It's available to professional investors over there, providing a regulated yield-generating way to get Bitcoin exposure.
The brilliance of this product, I think, lies in how it fundamentally transforms Bitcoin's role, potentially, in institutional portfolios. See, traditionally, Bitcoin being non-yielding, that was a significant hurdle, especially for mandates like pension funds or endowments. They often require some income generation.
Right, they need yield.
Exactly. This ETP cleverly packages a yield-generating strategy right into a regulated security. It directly solves those compliance hurdles. It means portfolio managers can now justify an allocation not just for potential price appreciation, which was always the main draw, but also as part of their income-generating strategies. This effectively opens up a vast new addressable market for Bitcoin, one that was previously pretty much inaccessible due to those mandate restrictions. It's really about bridging that gap between traditional finance needs and Bitcoin's capabilities.
Makes a lot of sense. Meanwhile, back here in the U.S., we saw maybe a minor pause, a temporary one, in the relentless flow into the spot Bitcoin ETPs, but the underlying trend seems firmly intact. On September 17th, the U.S. spot Bitcoin ETPs saw a modest net outflow, about $51.3 million. That followed a pretty strong streak of inflows, but interestingly, there was a clear divergence within that number. BlackRock's IBIT saw a healthy $149.7 million inflow.
Still strong inflows for IBIT then.
Yeah, but that was offset by withdrawals from Fidelity's FBTC and Grayscale's GBTC. So we're interpreting this mostly as temporary de-risking, maybe some profit-taking, not really a trend reversal, especially given IBIT's continued strength. And on the corporate treasury side, we're seeing some really aggressive conviction. Hyperscale Data, Inc., ticker GPUS, they're making big moves. Their Bitcoin holdings and committed purchases have surged to $8 million. That represents 34% of its market cap. And they have a stated goal of reaching 100%.
100%. That's not just conviction.
No, that's a complete strategic pivot. It signals a monumental belief in Bitcoin as a primary treasury asset. And it demonstrates that for some companies, it's becoming absolutely central to their corporate strategy.
Wow, that's a strong signal indeed.
And beyond just the investment vehicles, the actual infrastructure supporting Bitcoin is also evolving in some incredibly creative ways, especially how it synergizes with traditional energy. Take Buccaneer Energy. They're an international oil and gas company. They just formalized a partnership with BitGo. They're going to monetize stranded natural gas from their Texas wells by powering on-site Bitcoin mining.
Using waste gas to mine Bitcoin.
Exactly. And BitGo is providing the custody for the Bitcoin they mine. So it's literally solving a real-world energy problem with Bitcoin mining. Yeah. And on the tech side, XYRA Corp just secured exclusive licensing for this fascinating technology called cavitation non-thermal plasma. CNTP for sure.
CNTP, okay.
Yeah, for advanced submerged fluid cooling mining. This innovative tech is designed to significantly boost efficiency and hardware longevity for mining operations, really pushing the boundaries.
And if we connect this to the bigger picture, this convergence of energy and mining, it's becoming a really powerful economic and, importantly, narrative flywheel. Bitcoin mining is decisively moving away from just being seen as an energy consumer. It's becoming an innovative solution for the energy industry itself.
How so, specifically?
Well, it helps stabilize grids by soaking up excess power when demand is low. It reduces waste from natural gas flaring, which is a big environmental issue. And it makes intermittent renewables, like wind and solar, more economically viable by acting as a buyer of last resort for their excess electricity. They always have a customer. This is a truly compelling counterargument to those ESG criticisms, environmental, social governance, that have historically plagued Bitcoin.
So it flips the script on ESG.
It really does. It's becoming a win-win. Energy producers monetize waste or excess capacity they couldn't otherwise sell, and miners get access to cheaper, often more sustainable power sources.
That's a powerful counterargument to the ESG critics. But realistically, how quickly can this narrative really shift public and institutional perception, given how entrenched some of those criticisms are?
Oh, it's definitely a marathon, not a sprint. Public perception shifts slowly, no doubt about it, especially when there are established narratives out there. However, what we're seeing here are concrete economic incentives driving this change. That's the key. Companies like Buccaneers aren't doing this just out of, environmental goodwill. They're doing it because it's profitable and efficient for their business. And as more and more of these innovative partnerships emerge and actually scale up, the economic benefits become undeniable. The data starts to speak for itself. It moves beyond just being a counterargument to becoming a demonstrated economic reality. And that's ultimately what drives institutional perception and then eventually public perception too. It's a slow burn, but it's based on proving real value.
Got it. Slow but steady, driven by economics. Okay, and finally, to really grasp Bitcoin's long-term viability, we need to look at the global stage and the legislative push happening right now. The Chainalysis 2025 Global Crypto Adoption Index just came out. It confirmed India and the US are top for overall adoption. But interestingly, the Asia-Pacific region is the fastest growing, a remarkable 69% year-over-year increase in transaction value.
69%, wow. APAC is booming.
Yeah, and the report even introduced a new sub-index specifically for institutional activity, recognizing how important that's become globally. Back here in the U.S., lawmakers are renewing their push for comprehensive crypto legislation, specifically urging the Senate to pass FIT 21, the Financial Innovation and Technology for the 21st Century Act, and also the Clarity Act. And they're explicitly framing this as a matter of maintaining global economic competitiveness, pointing to regimes like the EU's micro-regulation markets and crypto assets, underscoring the urgency for the U.S. to, catch up.
And the bigger picture we need to see here in the sort of macro-political environment is this powerful three-pronged approach emerging in the U.S. You have the executive branch, through bodies like the SEC, actively creating clearer rules for the market. We just talked about that. This, in turn, provides both, let's say, political cover and a sense of urgency for the legislative branch, Congress, to pass those broader comprehensive laws like FIT 21. And then this combined clarity from the regulator and potentially from Congress gives corporate America, everyone from treasury managers to product strategists, the confidence they need. Confidence to build long-term strategies, allocate significant capital.
So it's like a feedback loop.
Exactly. It's a virtuous feedback loop. It systematically de-risks the asset class and accelerates its mainstream integration. It makes it much harder to just dismiss Bitcoin or crypto as some fringe technology. We're really moving from uncertainty to a much more defined playing field.
Okay, so wrapping this up, what does this all mean for you, the informed investor? Today's deep dive has really shown us an extraordinary alignment of forces, hasn't it? You've got a dovish Federal Reserve pumping liquidity into the system, telegraphing more easing ahead, paired with a significant regulatory green light from the SEC, providing those clear rails for that liquidity to potentially flow into Bitcoin and other digital assets. We're seeing institutional products mature, like that staking ETP. We're seeing corporate treasuries accumulating, like hyperscale, and even the mining sector is evolving its narrative, becoming more synergistic with the traditional energy industry.
Yeah, the fundamental investment case for Bitcoin, both as a risk asset benefiting from easier financial conditions, and as that long-term store of value against policy dilemmas, like the one the Fed is grappling with right now, that case has materially strengthened just based on today's developments. Now, should we expect short-term volatility? Always. Especially as it approaches and potentially breaks through major resistance like $120,000, that's natural. But the structural tailwinds supporting its growth, they feel clearer and stronger than ever before. And this truly raises an important question, I think, for you to consider moving forward. As this virtuous feedback loop of adoption, regulatory clarity, and technological innovation continues to spin, what new forms of institutional products and services might emerge next? And maybe how quickly will Bitcoin transition from being seen as primarily a speculative asset to becoming a core, perhaps even indispensable component of global financial portfolios?
That is definitely a lot to mull over. We certainly had a fascinating deep dive today. Until next time, stay curious.